Breaking news from the White House. U.S. President Donald Trump has officially signed tariffs on imports, following through on his self-imposed deadline. In response, Mexico has taken a dramatic step that could send shockwaves through the American automobile industry. With the newly elected President Trump imposing aggressive tariffs on Mexican imports, the Mexican government has enacted a countermeasure that threatens to upend vehicle manufacturing in the U.S. With one bold and strategic move, Mexico has disrupted the well-oiled machinery of the American auto supply chain, setting the stage for an economic showdown. For decades, the U.S. automobile industry has been deeply connected to Mexico's production and supply networks. American automakers depend on Mexican factories for key components, including wiring harnesses, transmissions, and even entire engine assemblies. Thanks to Mexico's lower labor costs, established infrastructure, and close proximity, it has been a crucial partner in vehicle production. However, with President Trump's tariffs jeopardizing this long-standing economic relationship, Mexico has responded forcefully by halting critical exports of auto parts to the U.S., a move that could bring vehicle production to a standstill. This was no hasty reaction. It was a calculated strategy designed to exert maximum pressure on the American economy. Without essential auto parts arriving from Mexico, factories in Michigan, Ohio, and Kentucky, reliant on a steady daily supply, will face immediate production slowdowns. Assembly lines will grind to a halt, causing widespread layoffs and economic disruption. Within days, the effects will ripple through the industry as manufacturers scramble to secure parts that are no longer crossing the border. Major automakers like Ford, General Motors, and Stellantis, each with significant operations in both countries, will face costly shutdowns, further escalating the crisis. Car dealerships, already grappling with inventory shortages, will find it even harder to meet consumer demand as the flow of new vehicles slows to a trickle. As a result, prices for both new and used cars, already at record highs, are expected to surge even further. Beyond the immediate impact on production, financial markets will also feel the ripple effects of this standoff. Investors, already wary of the economic fallout from the tariffs, will likely see stock prices for major automakers plunge. Supply chain instability will spark panic in the business community, triggering sell-offs in industries tied to auto manufacturing, such as steel, electronics, and logistics. Wall Street is bracing for what could become one of the most damaging trade wars in recent history. Politically, the stakes are just as high. President Trump has argued that the tariffs are necessary to pressure Mexico into renegotiating trade agreements in favor of the U.S. However, Mexico's swift retaliation has turned the tables, putting American auto workers in the crosshairs. Many of these workers supported Trump's economic policies, but now face the real threat of mass layoffs. The political fallout could be disastrous for the administration, as labor unions and industry leaders demand urgent action to prevent further economic damage. Diplomatic tensions between the two nations have reached unprecedented levels. While Trump insists the tariffs are essential to protecting American jobs, Mexico's response highlights the fragile nature of the global economy. Now, both governments are locked in a high-stakes economic showdown, with neither side showing signs of backing down. U.S. officials now face a critical choice: escalate the conflict with additional tariffs and trade restrictions, or seek a swift resolution before the damage becomes irreversible. The automobile industry isn't just a pillar of the American economy, it's a key driver of technological innovation and the employment. The tightly interconnected supply chains between the U.S., Mexico, and Canada were designed over decades to optimize efficiency and costs. Disrupting this system threatens not only North America's economic stability, but also the global competitiveness of American automakers. If production remains stalled for too long, companies like Tesla and Rivian, already struggling with supply chain bottlenecks, could face significant setbacks. Meanwhile, U.S. manufacturers will be forced to search for alternative sources for essential auto components, a challenge that could reshape the industry's future. Mexico's strategic role in this trade relationship is not easily replaceable. Shifting production to domestic factories in the U.S. would take years and require billions in investment. Many Mexican suppliers operate in highly specialized industries, where the necessary expertise and infrastructure simply do not exist elsewhere in North America. The reliance on Mexico is so deeply embedded that even temporary disruptions could have lasting consequences for the industry. Meanwhile, Mexico remains resolute, fully aware of the leverage it holds in this economic standoff. Although its economy depends heavily on exports to the US, Mexico has been expanding its trade partnerships in recent years. Strengthened ties with China, the European Union, and South American markets have provided alternative economic lifelines. In contrast, the US faces a much steeper challenge in reconfiguring its supply chain without cooperation from its southern neighbor. The ramifications of this crisis stretch far beyond the auto industry. The broader manufacturing sector, which relies on seamless trade between the two nations, is now on the brink. Concerns are mounting that rising car prices will dampen consumer spending in other areas, setting off a chain reaction that affects employment rates and overall economic confidence. The global impact is just as significant. Other countries closely watching this trade dispute may begin reconsidering their own economic ties with the US. If President Trump's tariff policies are deemed too unpredictable, nations that once depended on American markets may pivot toward more stable trade partners. Mexico's defiance of US pressure could also embolden other nations to resist protectionist measures, potentially reshaping global trade dynamics for years to come. As tensions escalate, industry leaders, economists, and policymakers are sounding alarms over the dangers of prolonging this economic conflict. The longer Mexico's countermeasure remains in place, the deeper the damage to both economies. Many are left wondering if this trade war will lead to a permanent shift in global economic power. Every passing day without a resolution plunges American automakers further into a logistical nightmare, forcing them to make difficult decisions that could permanently reshape the industry. Across the country, assembly plants have come to a standstill, leaving thousands of vehicles unfinished on production lines. Manufacturing executives are scrambling to source alternative suppliers. But this is no simple task. Many auto components require specialized production that cannot be easily or quickly relocated, making it nearly impossible to offset the disruption in the short term. The economic ripple effects are being felt throughout the entire automotive ecosystem. Suppliers, trucking companies, logistics firms, and dealerships are bracing for an economic hit that could take years to recover from. Every hour of halted production translates into millions of dollars in lost revenue. Major American automakers operate on razor-thin profit margins, relying on high-volume production to remain financially viable. With plants sitting idle and operating costs rising, companies that have spent decades fine-tuning their efficiency now find themselves facing one of the most unpredictable crises in modern history. The human cost of this crisis is just as severe. Thousands of auto workers are facing furloughs and layoffs as companies struggle to navigate the supply chain breakdown. In states like Michigan and Ohio, where the auto industry is the backbone of local economies, families are being plunged into financial uncertainty and entire communities are on edge. Generations of workers who have built the nation's industrial strength now wait anxiously to see if the situation can be resolved before the economic damage becomes irreversible. For the average American consumer, the effects of this crisis are clear: rising car prices and shrinking inventories at dealerships. As new vehicle production slows to a crawl, consumers are holding on to their aging cars longer, increasing demand for auto repairs. The used car market, which had only recently begun to stabilize, is once again experiencing record-high price inflation. Even rental agencies and rideshare companies are struggling to replace their fleets, passing higher costs onto consumers. Mexico's decision underscores the shifting balance of economic power in North America. For decades, the U.S. has dominated trade negotiations, but Mexico's bold response has exposed the limitations of that strategy by leveraging its crucial role in the auto supply chain. Mexico has forced Washington to rethink its economic approach. The future of the North American auto industry and the stability of the broader manufacturing sector now depends on finding a path toward cooperation rather than confrontation. In this high-stakes game of economic brinkmanship, both nations must carefully balance national pride with economic pragmatism.